did all these analysts, including people in the government, claim that we had peak inflation. I mean, I got sick and tired of hearing peak inflation back in 2021. I had to keep saying we're nowhere near the peak. And the same thing applies today.
You've got a number of juicy tweets that our producer sent over. So I like to, your tweets are always a source of both information and entertainment. So we picked the ones that highlighted both areas, entertainment and information. But first, I want to play this clip from President Joe Biden. He made a remark on the economy. Take a listen.
Today, we received news that our economy had 0% inflation in the month of July. 0%. Here's what that means. While the price of some things went up last month, the price of other things went down by the same amount. The result, zero inflation last month.
All right, so Biden's remarks, a little bit confusing here. I think he was talking about the month-over-month numbers, but overall, I didn't realize we had 0% inflation. But let's just go over the numbers just to be clear. So headline CPI rose 8.5% year over year, month over month, 0%. I think that's what President Biden was referring to. Core CPI rose 5.9% annually and only 0.3% month over month. So it seems like on a month-to-month basis, inflation has peaked. Do you agree?
Well, I don't agree at all. And first of all, what zero represents is Joe Biden's understanding of the U.S. economy, because he has no clue what's going on. You can't brag about the fact that we had one lone month where high prices didn't get any higher. It's not like they went down. They just didn't go up. But if people were struggling with high prices, their struggle didn't get any easier in the month of July. It remained the same. What would have been good is if prices could have come down, but they didn't come down. And in fact, the only reason that the headline number didn't go up was because we finally got some relief at the pump. Gas prices came down, but a lot of other prices, food prices keep going up, rents keep going up. In fact, you mentioned the core, yes, which doesn't include energy, was up 0.3 on the month. So if you annualize that, multiply it by 12, that's still a pretty decent sized number. Yes, it's not quite as huge as the numbers we've been getting, but there's always going to be an ebb and flow in these numbers. I mean, how many times last year did all these analysts, including people in the government, claim that we had peak inflation? I mean, I got sick and tired of hearing peak inflation back in 2021. I had to keep saying we're nowhere near the peak. And the same thing applies today. Yes, we may have hit a temporary peak. Maybe it'll take a few more months before we see a year-over-year increase that's higher than the 9.1 that we got in June. But there's no doubt in my mind that we will get a higher number than 9.1. We are nowhere near done with this inflation problem. It is going to be here for years and years and years, probably the remainder of this decade, and probably then some. And, so just looking at one-off month where, we didn't get a big rise and having this premature victory dance, I think is an insult to the American public.
Speaking of the free markets, well, the free markets seem to be kind of ignoring bad economic data. Well, maybe they are factoring in good economic data. Who knows? But the point is, Peter, for the last month, for a full good month, the S&P 500 and other stock market indices in the U.S. have been on a tear. Just today, just on Wednesday, the S&P is up 1.8% as we're speaking right now in the afternoon, in the middle of the day, close to market close. Now, you were talking about a financial crisis early in the interview. I want to talk about this financial crisis. It doesn't seem like the markets are anticipating a crisis anytime soon, or maybe they're just ignoring, maybe investors are just ignoring some of the signs, Peter.
Well, that's because they still remain hopeful that the Fed's going to be cutting interest rates by next year. Now, in fact, they may be cutting interest rates before the end of this year, but it's not going to be because they've won a victory over inflation. It's going to be because the economy is in a much more severe recession than the one it's in right now. In other words, this recession that's here is going to get worse, and that's going to force politicians to try to do something. Once the political pressure is greater because of unemployment and the economy, then the Fed is going to switch its attention from inflation. But the inflation problem is not going to go away. It's just that this other problem is going to loom larger in the eyes of the Fed. And I think what's driving the markets is this bad news on the economy is good news for the markets because it means the Fed will pivot sooner. And before it pivots, it will raise rates less than it might have raised, absent the bad economic news. And again, you still have all of these Keynesians out there that think bad economic news is good news on inflation. They think the weak economy will weaken inflation. It won't. It is going to strengthen inflation, especially when the Federal Reserve and the government respond to the weakening economy with more stimulus, because that stimulus is inflation. So they're going to start creating more inflation, even though we already have too much inflation. And so the problem is going to get much bigger than the markets understand.
How long do you think this rally is going to last then, Peter?
Well, I don't know. I mean, I still think this is an overall bear market. I think that rate hikes are going to continue to take their toll, but so will inflation. I think inflation is going to harm a lot of companies that have a problem dealing with it. I think a lot of demand is going to be destroyed for a lot of discretionary items because people are going to spend all their money on food, on energy, on insurance, on rent, on taxes, especially if we get another, 80,000 IRS agents that are going to be harassing the middle class, a lot of small business owners and the people who are self-employed. They're going to be spending a lot of energy dealing with the IRS that they won't be able to spend working. And then the IRS is probably going to shake them down for some additional taxes, interest, penalties. So people are going to be dealing with that. And that's going to be another problem for companies trying to sell American consumers products when they're broke.
I had this discussion with a friend the other day. We're talking about layoffs, particularly in the tech sector, Netflix, for example, Coinbase, companies in the crypto sector. And he was saying that, well, this is not indicative of the entire economy. These companies were just poorly managed companies that overhired during the pandemic. Do you agree with that sentiment?
Well, I agree that these companies probably way overhired, but they're not the only ones. Sure. There are a lot of companies that are losing money. I think last year we set a record for IPOs of companies that lose money. And so all of these companies, zombie companies, are creatures of the bubble that was inflated by the Fed with inflation, artificially low interest rates, zero interest rates, and quantitative easing. That's what gave birth to all of these zombie companies. And now that the Fed is raising rates and is no longer doing quantitative easing, all these zombie companies are going to die. And it's a lot more than just Coinbase and Netflix. And, I don't think Netflix is going to go away. I mean, I think Netflix is a viable business, but investors have way overpaid. It's very competitive now. There's so many streaming services out there, and the public can't afford them. I mean, they don't have enough money for all this content. And so there's a lot of competition. It's very easy for people to subscribe to one of these services for a week, binge watch whatever they want to see, then cancel their subscription. It's very easy to just use a family member's subscription, a friend's subscription. So people are going to find a way, to circumvent a lot of this. But companies like Coinbase, I mean, that's all part of the crypto bubble. I think most of the blockchain crypto-related companies are going to go out of business. I don't think they have viable business models. I don't think most of these cryptocurrencies are viable. In fact, I don't think any of them are. I think all of them, including Bitcoin and Ether, are ultimately going to zero. It may take a while before they, flatline completely. There'll always be some fools willing to buy, thinking they're going to get a bargain. But I don't know how long a lot of these companies will be able to stay in business and keep writing paychecks when they no longer have access to capital, because they don't have any earnings to fund their operations. They rely on selling stock to investors who just believe that they can buy the stock and the price will go up. But when that fantasy meets reality, these companies are not going to be able to access any capital. And so they're going to have to slash their workforce, and many of them will end up just going out of business completely.
All right. If you want to go there, let's go there. We're going to talk about cryptos towards the end of the interview. One more question about the financial markets, and we'll move on to that, Peter. I know you love bashing cryptos. Okay, financial markets, financial crisis. What should investors do then right now to prepare for this financial crisis? Is now a good time to be picking stocks? Should you go bottom up, Peter, or should you wait in the sidelines, or should you just stick to an index fund, maybe buy gold? What should people do?
Well, I think the nature of this financial crisis is going to be a lot different than the one we had in 2008, because I don't think the Fed is going to allow it. That's one of the reasons I believe that Powell is going to pivot, because if the Fed does keep raising rates, we will have a financial crisis that looks like 2008, only much worse. Because 2008 was about bad debt. It was about people borrowed money and they couldn't pay it back. And the collateral for the loans was no good because it was real estate and prices went down. Well, we have much more debt now than we had in 2008. I mean, by an order of magnitude. Everybody has more debt than they had back then. And so this is going to be a much bigger crisis when the defaults start. And all those banks that were too big to fail, that were bailed out in 2008, they're a lot bigger now. And when they fail, it's going to be a lot worse, except with inflation too high and the Fed fighting inflation, there are no bailouts. There's no TARP 2.0. All these banks are going to have to be allowed to fail. And that means customers are going to lose money, not just stockholders or bondholders. The customers are going to lose money because the FDIC doesn't have any money unless it gets it from the Fed. And the Fed isn't going to be giving out money if it's fighting inflation. It's taking away money. So I believe the Fed is going to pivot to prevent that massive financial crisis. And so what we're going to get is a sovereign debt crisis and a US dollar crisis. So it's going to take the form of a crashing dollar. And so the people who are going to lose money are not the people that are just holding subprime mortgages, but the people who are holding US Treasury bonds or any bonds denominated in US dollars, or even people that have US dollars stuffed under their mattress. You know, the dollar has risen so far in the early stages of this big inflation because investors are still delusional about the Fed's ability to contain inflation and bring it back down to 2%. When they wake up to reality that inflation is going to be way above 2% indefinitely, then the dollar is going to fall through the floor, and then things like gold and silver will go through the roof.
Okay, let's talk about that briefly. I don't think, to my knowledge, Peter, correct me if I'm wrong, but to my knowledge, I don't think the U.S. in its history, in modern history, has ever experienced a dollar sovereign debt crisis to the point where default might be on the horizon. Is that what you're describing is going to change every single finance textbook that defines treasuries as AAA, AA, depending on whatever, rating agency you're talking to?
Well, not quite, David, because remember, in 1971, the U.S. defaulted on its obligations because Nixon took us off the gold standard. But prior to that, if you owned a Federal Reserve note and you were a foreign central bank, you owned an obligation of the United States government to pay you gold. Federal Reserve notes were notes for gold. And the U.S. government defaulted on those notes. We told all of our international creditors, we promised to pay you gold. If you had $35, we promised you an ounce of gold. And they did a couple of devaluations first, but that wasn't enough. And then Nixon said, you know what? We're going to default completely. We're going to give you no note gold for your notes. We're going to pay nothing. So that was an official default. And then gold went from $35 an ounce up to $850. So people who had U.S. Federal Reserve notes, thought they were going to get a certain amount of gold. They ended up getting a fraction of that gold because the value of the dollar imploded relative to gold because we defaulted on that promise. But we didn't officially default on treasuries, but we defaulted on the fact that those treasuries were supposed to be repaid in gold. Because when we repaid treasuries in Federal Reserve notes, that was the equivalent of gold. They used to say the dollar is as good as gold because it was not only backed by gold, but redeemable on demand for gold. So that was the first default. This default is going to be different because obviously we're no longer on a gold standard. So nobody who owns U.S. treasuries or U.S. dollars has any expectation that they're going to be given gold. But they do believe they're going to be able to afford to buy gold. They're going to wake up to the reality that gold's going to be so expensive in terms of dollars, they're not going to be able to afford to buy any. Because I think the dollar is going to implode, and I think it's going to lose its status as the reserve currency. And that is going to be a game changer for the U.S. economy because we rely on the ability to exchange the paper we print, U.S. Federal Reserve notes, dollars, for the goods the rest of the world produces. So we are dependent on the rest of the world for the goods that we consume. And we don't have to produce goods in exchange. And that's been the free ride that we've had on this global gravy train. And that's going to come to an end. And that's going to have profound implications for the U.S. economy and the standard of living of America.